Retirement is a time to enjoy the life you have worked so hard to build. But even after the paychecks stop, your money still needs to work for you. The truth is, how you manage your investments in retirement is just as important as how you saved for it. So today, let's walk through 9 of the most common investment mistakes retirees make, and more importantly, how to avoid them. Mistake number 1 is chasing yield. It's tempting to go after investments with the highest returns, whether it's high dividend stocks, junk bonds, or complex products promising you a bigger payout. But often, higher yield means higher risk. And in retirement, preserving your capital is just as important as growing it. Instead of chasing yield, focus on total return. That's income plus growth, balanced with your risk tolerance and time horizon. Mistake number 2, underestimating longevity. People are living longer than ever. A healthy 65-year-old today could live well into their 90s or beyond. That means that your retirement portfolio may need to last 25, 30, or possibly even 35 years. Underestimating this can lead to running out of money far too soon. So plan as if you are going to live a long life, because if you do, you'll be glad you did. Mistake number 3, ignoring inflation. Even a low inflation rate can eat away at your purchasing power over time. A dollar today won't buy the same in 10, 15, or 20 years. That's why it's important to keep a portion of your portfolio in growth-oriented investments like stocks, even during retirement. Being too conservative might feel safe, but it could cost you in the long run. Mistake number 4, failing to diversify. Many retirees stick with what they know, sometimes too much so. They may be overinvested in one stock, one sector, or even just the US markets. Diversification spreads risks across asset classes, across geographies, across industries. It's one of the most simplest and most effective ways to protect your portfolio from surprises. Mistake number 5, withdrawing too much too soon. Spending too aggressively in the early years of retirement can seriously damage the long-term health of your portfolio. One popular guideline is the 4% rule, withdrawing 4% of your portfolio in the first year and then adjusting for inflation. But depending on your lifestyle, market conditions, and income sources, you may need a more flexible plan. A good rule of thumb, start conservative and adjust as needed. Mistake number 6, poor tax planning. Too often, retirees think only about how much they withdraw, not how those withdrawals are taxed. Traditional IRAs and 401k withdrawals are fully taxable. Social Security can also become taxable depending on your income, and capital gains and Roth conversion can push you into higher tax brackets. The solution? Work with a professional to create a tax-efficient withdrawal strategy. It could save you thousands over time. Mistake number 7, timing the market. Trying to jump in and out of market based on headlines or gut feelings is a risky game, even for professionals. Retirees in particular can't afford big missteps. Selling at the wrong time, especially in a down market, can lock in losses and derail your long-term plan. Stick to your strategy, stay invested, and remember, it's time in the market, not timing the market, that builds wealth. Mistake number 8, ignoring healthcare costs. Healthcare is one of the largest and most unpredictable expenses in retirement. Many retirees fail to plan adequately for out-of-pocket costs, long-term care, or supplemental insurance. Building healthcare into your financial plan early can prevent unpleasant surprises later. And finally, mistake number 9, going at it alone. Investing in retirement is complex. It involves tax planning, risk management, income strategy, and behavioral discipline. Yet many retirees try to do it all by themselves, sometimes because they think it saves them money, sometimes because they don't know where to start. But a trusted financial advisor can help you avoid these common mistakes and give you a clear, confident path forward. So let's recap. Retirees often make the mistake of chasing yield, underestimating how long they're going to live, ignoring inflation, failing to diversify, withdrawing too much too soon, missing tax opportunities, trying to time the market, overlooking healthcare costs, and trying to do it by themselves. But the good news, with the right planning and a solid strategy and some guidance along the way, you can avoid these pitfalls and build a retirement that's not just secure, but also fulfilling. If you like help in your retirement journey, please contact us at info@advisormanageportfolios.com. We look forward to speaking to you soon. Till next time.